Welcome to Market Pulse this Wednesday morning, and today we want to have a conversation around credit reference bureaus and also credit rating and the impact that that has in terms of pricing your credit. And to help me with this conversation, I'm joined in studio this morning by Gideon Kipiakwai, who is the CEO, Metropole Credit Reference Bureau. Gideon, welcome to the program.
Thank you, Jamie. Very happy to be here at Market Pulse.
All right, thank you so much. So one of the things that we want you to help us understand, when you look at credit rating, the one thing that a lot of consumers do not understand is the metrics used to rate a person's credit risk and credit worthiness. Can you take us through that?
Thank you, Jamie. The decisions that people who lend or people who want to invest in an instrument, in a financial instrument, involves questions around, if I give you money or I lend money to you, will you pay me back? Yeah. And to assess that creditworthiness, you have to look at the person's track record in the past. So there's a lot of prediction of whether that person will return the money, will you pay you back based on what he has done in his other credit facilities. So this is the basis for credit rating and credit scoring. Now, those two words are not interchangeable. When we talk about credit scores or credit scoring, we're generally looking at just the individual, giving them a credit score. And to get that number, we look at the nature of facilities they have. And nature here, I'm talking about the length. Are they borrowing short or long-term loans? Secondly, we look at the payment history. Mm-hmm. When they borrow, how have they been repaying? Thirdly, we look at now the other issues around character in terms of in paying. Do they get late? Do they pay early? etc. Now, when we talk about credit rating, which is what you have asked, a credit rating applies mostly to businesses, but we also have cases where individuals can be rated. I'll give you an example. There is a cousin of mine who wanted to start running. Yeah. And he needed me to give him money. In that case, then I don't look at saying a credit scoring situation, but I'm looking at a credit rating. Does this guy have a potential to run? Can he win a marathon? So that if I give money to him, he's likely to give me back. So this is the issues that credit ratings look at, the potential for future cash flows, the viability of the opportunity. So credit ratings has a broader scope than credit scoring. But in this market, we are happy that the market has shifted to, as a CRB, we are looking at the market looking at credit scores rather than a particular snapshot of whether the person is in default, what we used to call blacklist. Yeah? Mm-hmm. Just looking at how have they performed in the past and giving them a score. Yes. All
right, so Gideon, when you look at credit rating, particularly its impact on the value that then one is charged in interest, how does that correlate with the interest that I'm going to be charged as a consumer for the facilities that I have?
Wow, that's a very good question. This market has shifted to what we call credit risk pricing. In credit risk pricing, because of what I described in terms of, are you likely to pay back the money? Are you likely to pay back on time? Mm. All those things have cost consequences. If you're not likely to pay me back, it means I'll lose, as a lender, I'll lose that capital and I will lose the possible income. And remember, that income is what investors who've invested in the bank require as a return. So it is a cost because there is inherent probability that a borrower will not pay back the money. Mm-hmm. Now, when you talk about what is it likely to be in terms of cost, now, you must have seen in the last 1 or 2 years, banks are advertising, and most lenders are advertising that now we are charging you a base rate, a bank base rate, plus a risk premium. Now, that risk premium is computed based on the credit risk, or what I was calling the score or the rating of the person. Now, someone with a very good score, in Metropole, our credit score range from 200 to 900. Generally, that is the range of credit scores in the market. So somebody with a good credit score has scores of above 600. Somebody with a bad score, we talk about scores below 400. This is, from a probability point of view, as you move towards 200, the probability of default increases to close to 1. As you move to 900, the probability of default moves towards 0, which means this customer is likely not to default. Mm-hmm. So from a cost perspective, the expected credit loss out of that situation is very minimal. Mm-hmm. So now, a consequence to that, today in the market, typical bank base rates are about 14.5%. So now when you load risk premiums, you get some people paying 16% in their interest. We have others now in this market paying 10% over the base lending. So you get somebody being lent 25% in terms of the typical loan facilities.
All right, so Gideon, there's also this concern that there could be a risk in maintaining a similar credit rating over time. And what is that risk? And again, how do I improve my credit rating? And what are some of the things that maybe might lower my credit rating and make me a high-risk individual or a low-risk individual?
Great. So quick ones. Number one is honoring your credit contracts. That definitely improves your credit score. So when you take a loan that you ought to pay by 30th, for instance, if you pay on 30th or before, that improves the direct impact. In fact, from a weighting perspective, close to 40% of the weight that goes into credit scoring and credit ratings is payment performance around contract terms. So if your loan is a 2-week loan, make sure you pay within 2 weeks. If your loan is you're paying in cycles of 6 months, make sure you pay on time. Number two is managing the kind of facilities you are taking. So you could be having this loan that you're paying very well, but at the same time, you are now getting additional facilities that are not favorable to the kind of business you are in, or as an individual, you are starting to take short-term loans, you're going into short-term facilities. Those ones start hurting your score. So you have to make sure that as you manage your loans, you manage your loans within the kind of business model you are in. So it's important to not just borrow because you have ability to borrow, but you must make sure that you reduce shorter term loans and go for longer term loans. Number three is in terms of reporting. A lot of the people in this market do not have a lot of their transactions available in their credit profile. Now, what does that mean? If you are taking a loan with a SACCO, please, we are urging members of SACCO directors to make sure that they submit that data to the CRB, because that data then has a lot of positive impact on the credit profile of the person.
All right, now there's the question of looking at the risk-based pricing model that a lot of Kenyan banks then have gotten approval from the central bank to start implementing. There's the question of why do we still have the same amount of rates cutting across all customers? Because the expectation would be that once we go into risk-based pricing, then for some customers with a good credit score, that their interest would start coming down, but we're yet to see that. Where is the disconnect?
I think what you mean is that the interest rates have not come below the base rate. And, this is to do with fundamentals. Banks today, what are they paying for deposit? For fixed deposits, for call accounts? You find that the cost of funding in this market is still very high. Banks are paying upwards of 10%, 12% in cost of money, the money they are getting. So you find definitely they can't lend at rates less than what they are getting the money for. Number two is cost of administration. So load that on the 12%. So you get 12%. You now think about a margin. So banks are in the business of lending money. So they've gotten money from investors, from depositors. Now they have to lend that money out. So they put the cost of lending and then put a margin. Now you arrive at the base rate. Now, your question is around, after this base rate, what should the customer be charged? So you find now, this is the spread I was talking about, from the 14.5 going all the way up to whatever rate. Because this is now, so median rate, what is the median interest rate today? It's about 18%. But we still have customers getting at 15%. Those good customers who have very good scores are borrowing at 14.5, 15%, depending on the amount of the loan. Now, customers with poorer scores then tend to have above 20% in terms of the interest rate.
All right, so what are the other non-interest costs in as far as a good credit score would get you, for instance, in terms of collateral requirement?
Yes. So in calculating the expected credit loss, which is the biggest component in the credit risk pricing, we have three main variables. So we have what we call probability of default, and this I have explained a bit. But that probability of default is derived very easily from the credit score and the credit rating, based on the bucket that you are in. Are you a high-risk borrower or a low-risk borrower? The next variable that is important in computing that expected credit loss, which is what is actually going to be in the interest rate, is loss given default. That is, assume you default. What recourse does the lender have? Does the SACCO or the bank have? So that loss given default, the issue around there is, do you have a collateral? Because if you have a collateral that if you default, I have access to disposing, I have access to it and to dispose it, then in that case, I can charge you a lower rate. Because even if you default, I can still recover my money.
Yeah.
Thirdly is what we call exposure at default. Now, generally, longer-term facilities have a higher exposure at default value because of the time lag. So as you think about, say, a one-year facility, based on models, we can predict when that facility is likely to go into default. So maybe at the 6th month, the 7th month. Now, at that 7th month, what is the balance of that loan? That's what we call exposure at default. So assuming you take a 1 million loan that we amortize across the year, you say it will be at 0 at month 12. So maybe at month 6 thereabout is probably 500,000. So say exposure at default. So this gives you a scenario around when you are computing expected credit loss, the amount at the time when we compute now, day 0, what figure are we putting as a possible exposure at default so that we determine the expected credit loss, which we convert into an interest rate, we load into your account. So these are the three key variables. Now, from a total cost of credit perspective, the reason this market needs to work on information sharing, and this for me is going to help everybody. If all of us share information with the CRB, we help this market to move from a perception that we have very bad borrowers. In essence, this market, even the SMEs, are very good borrowers. So if we move from a perception where people are not, whenever they take loans, they are not paying, to a perception that when we take a facility as a business or an individual, we pay, this base rate that we are talking about will significantly come down. A lot of markets are lending at single digit. It's possible for Kenya to have an interest rate regime that is 1 digit, 8%, 9%, 6%. And for me, that can be achieved by removing the information asymmetry where everybody is disclosing how we are performing. And it has a deterrent effect other than also removing generally the moral asset. People who borrow and are hell-bent or not repay.
All right, so two final questions because I can see time is really running out for us. So one of the things that I want you to help us with, at what point am I credit rated? Is it at the inception where I'm taking my loan, or is it at the point that my loan has matured, I have prepaid or defaulted if need be, depending on the contract that we had with the financial institution? And number two, when you look at the pricing of loans, what role does risk pricing then play?
Yes. So today, as Metropole, we have credit scores of all 23 million Kenyans who have taken a facility somewhere. So the score is there. Your score is available whether or not you are in the process of being assessed for a loan. You dial, anybody can dial *433# and get their credit score, whether or not you are borrowing. So credit scores are computed based on your data. Now, when you go to take a loan, the institution that is assessing you now pings or queries your credit score. Now, we encourage people to know their credit score way before they go to a lender. Because it's important, you can start working on improving your credit score by checking and making sure that your historical facilities are being reported correctly. If you had borrowed, say in a SACCO, you make sure that that data is in your profile. If there is somebody probably who has used your telephone line and has borrowed using your ID and that account is in default, you make sure that is rectified so that when you go to the bank to try and get a loan, you are not denied facility out of an information that is not necessarily yours. So that is number one. So the score, so direct answer, the score is available when you are borrowing, before you borrow, even after you borrow, because it's something that is auto-generated on the fly. Now, for ratings, generally speaking, you hear about Kenya has been rated whatever, BBB.
Yeah.
That rating is available continuously. Why? Because Kenya has a lot of debt instruments out there. We have a lot of bonds. We have T-bills. So that investors need to assess continuously what price to attach based on risk. So this risk-based pricing is just that it is becoming a common conversation now in this market because we've just shifted the consumer lending to risk-based pricing. But at sovereign level, at large corporates, if you go to the stock exchange, this risk-based pricing has always been the norm.
All right. Gideon, thanks so much for making time to come and speak to us on this issue and also just looking at some of the importance. Because again, let me just think in a quick question before you go in 10 seconds. Why is it important for me to have this credit rating? And for customers who do not have a history of borrowing, what does their record look like? In 10 seconds.
10 seconds. If you don't have a credit history, you have a neutral score. So we don't know whether you are a defaulter or you are a good borrower. So you need to start having at least some credit facility for us to gauge whether you are a good borrower or not. Number two, you as a borrower in Kenya today, by having a good score, you enjoy better interest rates. And to get a good score, engage the CRB, get access to your credit report, know what is in your profile, and make sure that positive information is shared with the Bureau. With that information at your fingertips, you are able to negotiate for better interest rates. All
right, Gideon, thanks so much for making time to be on Market Pulse this Wednesday. And of course, let's do this again, same time, same place next week, right here on Hot 96.
Thank you, Jimmy. My pleasure to have been on Marketplace. Pulse.